Today's video was inspired by this excellent podcast episode on Hidden Brain called Money 2.0, Why We Bust Our Budgets. Awesome episode. I'll be sure to link to it in the description, but I wanted to cover the main points today, add my reaction and thoughts, and in the end, I'll share tips to help you avoid falling into hidden money traps so that you can start saving more money. We'll cover 2 major budgeting blind spots, how mental accounting holds you back, and solutions to help you save. But first, my name is Frankie. Like if you liked the video and I earn it, subscribe to see more from me, and let's dive in. Starting with unpredictable expenses. Unpredictable expenses are unpredictable by definition, so many of us exclude them from our budgets. However, even though it's hard to predict what the specific unpredictable expense might be, you can still predict that you will have unpredictable expenses. Oftentimes, these unexpected expenses are predictable. They're just so infrequent, we don't account for them. Here's an example. Wedding gifts. You know a friend's wedding is coming up, but you don't account for the wedding gift in your budget because it's a one-off expense. It's not something you spend a lot of time thinking about. It's predictable, but you didn't account for it. And the same might be true for all gifting throughout the year. Holidays, birthdays, weddings, graduations, and so on. Most people don't plan gifts into their budget, or if they do, they don't account for all the gifts in a year or use last year's gifting total to dictate a budget. Common car and home maintenance are other unpredictable expenses that you can and should predict. Further, we're likely to overspend on what we deem to be one-off events because they don't come around often. We tell ourselves it's okay because it's such a rare event or expense. This is a one-time event, so it's not going to hurt the budget, right? It's hard to understand the larger impact because events sometimes are quite infrequent. An example is a home renovation. As soon as you get into the project, it's extremely easy to go over budget because you end up going slightly higher in quality with each part of the project because you hope to only renovate once, spend 5% more here, 15% more there, and so on, and soon that gets you into hot water. Speaking of, get the hot water heater that's 25% more than budget because you might squeeze a couple of extra years out of it. Even as a self-proclaimed money nerd, I'm not immune to this concept. We actually went about $80,000 over budget on our first home we bought about 6 months ago because we saw ourselves in this house for a very long time. We justified it by talking about all the money we're going to save in the long run on maintenance and upkeep since it's a new build. That might turn out to be true, but maybe we just needed a reason to make ourselves feel better. The same occurred actually when planning our wedding. We went close to 50% over our anticipated budget for the wedding. Right after our engagement, we researched and listed out our budget line by line for each category of spending. We even read all the statistics about how couples tend to go 50% over budget. We proclaimed that would never be us. It was. You only get married once, we said often, to justify it all. For you, this might be spending more on vacation to a place that you probably won't ever visit again, or spending more on a set of new tires in hopes of not needing to deal with replacing them again for a long time. At one point in the episode, they did sketch out a relatable, hypothetical scenario of one-off events. One of your favorite bands is in town, so you splurge because they don't come around often. The next week, your TV breaks. You spend on the best because this isn't a purchase that you make often. The week after that, you're celebrating a big wedding anniversary, so you go big on dinner and an event, and suddenly your budget for that month is totally busted. Sadly, these unpredictable events or expenses are actually the most common reason people withdraw money from their retirement accounts. These withdrawals cost consumers around $7 billion a year in terms of penalties. Pew Research found around 60% of households reported having unplanned financial shock. 26% said they faced difficulty saving because of unexpected expenses that they didn't account for most months. So, here's a challenge. Reflect back on unexpected expenses that you've had in your life in the last year and list out how much each cost you. And let me know if any examples come to mind right away or a time that you justified spending more because it was a rare, perhaps one-off event. Next, let's talk about the concept of mental accounting. We rationally know that a dollar is a dollar, but emotionally we treat some dollars differently. We should treat all of our money the same, but we don't. With mental accounting, we place money into different buckets. So here's my rent bucket, here's my utilities bucket, my food bucket, my savings bucket, and so on. But the problem with mental accounting is we don't treat our income the same way. The source effect is a type of mental accounting that allows us to treat money differently depending on its source. Windfalls such as a bonus, winning at the casino, or an unexpected inheritance cause us to spend on different things than we typically buy. Recently, many people received tax refunds, and most people spent this money right away. Most people don't realize that it's not free money. This was always your money. The government is essentially returning your loan to them back to you. In a worse scenario, people spend the same windfall multiple times over. Tell me if you've ever done something similar. You get a bonus of, let's say, $500. You spend $250 on, shoes and a ticket to a show. That's okay, I just received $500. You buy a new kitchen appliance for $250, but I deserve it. I just received $500. Then you book a weekend away for $500 because I deserve it. I just received $500. Sure, you just received a $500 bonus, but you lied to yourself and spent $1,000. You spent the windfall many times over. In an even worse scenario, studies have shown that people tend to take out car loans more often after they receive a bonus. So let's say you earn a $5,000 holiday bonus and you put all of it towards a down payment on a car. That's great, but now you're stuck with hundreds of dollars a month in payments, plus gas, and of course, maintenance. The source effect works similarly when it comes to how you're paying. It's much easier to part with money via a credit card than it is when you're paying with cash, and that's why many people stick to a cash envelope system. Another form of mental accounting is called the context effect. The context effect explains why we spend money differently based on where we are. It's why you might spend $10 on a hot dog at a ball game or $15 on a beer at the airport. Part of it is limited supply, but the other part is it feels acceptable because it's a special event. Do you always remember to account for extra spending on food and drinks when you travel or go to a ball game? I certainly forget time to time. I do notice that the prices are outrageous, but I justify purchasing because I'm hungry. It's certainly my only option, and this is a special exception. There's another form of mental accounting called the ratio effect, and this is best explained by a study that was done showing people are willing to drive 10 extra minutes out of their way to save $5 on a $25 clock radio, whatever those are, but they aren't willing to drive 10 extra minutes to save $5 on a $500 TV set. It shouldn't matter because $5 is $5. Yet most of us have probably done something similar because of the ratio effect. I'm willing to go out of my way to save on parking, but not always to save on gas, even though they both save me a similar amount. And finally, the episode covers the what the hell effect. And this happens when you set a hard goal for yourself, but you don't meet it. At that point, whatever restraint we would normally apply just goes out the window. This happens when your budget is already shot in a category, let's say halfway through the month, so you say screw it and give up. You're so far off track your savings goal, you stop saving because what's the point? This happens the most often when it comes to discretionary money. Unfortunately, companies know about these psychological weaknesses and they prey on them. I think about exiting a ride at Disneyland or Six Flags or whatever, and at the end, they show a photo that they snapped during it, and it's hilarious. So how could you not buy that $20 photo of Uncle Jim's face? Companies might also offer sales during tax refund season to get a piece of your return. You think, I just saved $50 on a $100 pair of jeans with free money, instead of realizing you just spent $50 on something that you didn't need instead of saving. Before I get to a few tips and solutions, here's a summary of the psychological budget busters that I've covered today. First, I talked about accounting blind spots, which are unexpected expenses that you should be expecting. Then I covered one-off events and spending more than you budget for because it's a special situation. Then I covered 4 types of mental accounting. The first is the source effect. It's how we treat money differently based on where it came from, such as splurging away windfalls. The context effect is spending more because of the setting. The ratio effect is where we're willing to go out of our way to save a few bucks in some scenarios, but not others. And finally, the what the hell effect is pretty self-explanatory. I'd love to know which of these have affected you, especially if you have a recent example to share. Do you have a weakness that spoke to you today? Let me know about it in the comments if so. For me, I definitely tend to justify going over budget when I'm in the market for a bigger purchase. And right now I'm looking at TVs for the first time in a while. Plus, I'm a sucker for food and drinks at ball games. Okay, let's cover 3 quick tips as solutions. First, find a way to reclassify unexpected expenses. With gifting, you should think of this as a category and plan for it rather than thinking of gifts as individual expenses. I plan on $100 a month in my budget personally. You could also call it a special occasion budget instead. Next, when you go to a special event, plan an event like a vacation, or start a project like a home renovation, come up with your budget, of course, but assume it's going to cost about 20% more as a general rule of thumb. If it's less, fantastic. If it's more though, at least it's not gonna be a total budget buster. And by the way, if you can't afford to make that extra 20% work, maybe it's time to reconsider if you're even ready to do the event or take on the project. Either way, be realistic so you don't what the hell it. And finally, turn mental accounting into your superpower. Automate your savings and investing right away when you get paid into your buckets, then leave it alone. Retirement funds only go one way. Use mental accounting as a self-control device. Pay yourself first so that you never see the money to tempt you in the first place. And that's it. My name is Frankie. Like this video if something I covered today spoke to you. Subscribe if you want to see more from me. I've been on a bit of a money mindset kick lately. If you've enjoyed this video, check out this one next. It explains why it's so easy to overspend and what to do about it, or this one where I cover something called the emergency fund account. I'll see you there, or I'll see you next week on the next one. Thanks.